We will be talking about RingCentral, symbol RNG today, and why I think that it is significantly undervalued. So basically, we, here's my spreadsheet. Some key points here is that RingCentral has a narrow moat, and it is also the leader in its sector. The Unified Communications as a Service segment, with RingCentral holding about 25% market share. RingCentral's strategy for growth is to invest aggressively in its own business, particularly in the R&D sector and sometimes in the sales and marketing sector. I believe that the strategy will generate excess returns to shareholders, as gaining market share is crucial at this stage. With actually let me see, market growth, I think it's around 15-16% a year for the next 10 years. So it really is important to seize market share here. Uh, yeah, 24% actually from 2021 to 2028. That really is huge growth. And as you can see from this model, this is actually my most conservative model that I did with RingCentral. So actually over 2028, I actually modeled. Let's just see real quick here. Uh, Average. Oops. Anyways, I act looks like around a 15%, 15-16% growth rate, even though its market share would grow that much. Its market would grow that much, 24% a year actually, and RingCentral isn't going to lose market share in my opinion, but this is just to be more conservative. Also, this is also using a 13.5% discount rate, which implies a 3.5% treasury yield and a 10% equity premium, which is way higher than what most people use here. On the free cash flow side, I modeled that because in the long term, businesses that revolve around around the same business model as RingCentral usually tend to hover between 28 to 30% free cash flow margins in the long run. 5% is really reasonable, in my opinion, for a high growth market like RingCentral, as more and more people are shifting from traditional phone systems to cloud based phone offerings. Uh, so, RingCentral's main competitors that you might want to focus on are basically Mattel, Microsoft Teams, Zoom, and some other smaller private players. Maintaining a leadership position is probably going to be based on customer satisfaction and the level of investment into its own business. Uh, so this fair value of 67 would be my gray sky scenario. Actually, my blue sky scenario would be closer to what Morningstar actually did, whereas so yeah, Morningstar actually modeled a 125 fair value, and Morningstar is a pretty credible source. So basically, some some of what bulls say for Morningstar is that you can just read it yourself here. Uh, and so they actually model a 5-year growth rate of 2020 of 22%, which is roughly in line with me, but they just think that RingCentral has a better long-term growth uh, portfolio profile than most companies have, and I don't disagree with that. Uh, like with RingCentral, there is more uncertainty into it, as it honestly a large part of where it goes in the future is how competitors like Microsoft Teams and like how much money Microsoft actually invests into their offering. But basically, currently its free cash margin is at 8%, which is that's outstanding, especially considering it's still growing at 30%, and its free cash margin even is rapidly growing. ARR is up 35% year over year, basically annual recurring revenue, or uh, So this is their most recent earnings tech. So basically, this is just saying why they're better than basically just marketing stuff here. They these are some of their strategic partners. Mattel actually is in here, one of their competitors. So they also do have integrations with Microsoft Teams and Mattel and 8x8 and all their competitors. So that like and Zoom too. Yeah, if you use one of you could still use Ring's products even though you use another offering basically too. Uh, so some megatrends, which is basically what it also mentions Microsoft here, which is interesting. Its pipeline's up 50% quarter over quarter. Here it talks about Mattel. Avaya actually, Avaya is another dark point in Ring. I think it's close to going bankrupt actually. Yeah, it's up. It's down like 95%. Basically, it has some financial problems, as you can see here, but that would only cost Ring like a couple hundred million. So operating margin, that's non-GAAP, yeah, is 10.4%, uh, which is pretty solid. They're above the rule of 40, which is something you should always look at for a SaaS company, as which is rule of 40 is basically revenue growth plus some people use operating margin, some people use free cash flow margin. Really, most companies just choose whichever one makes them look better, but regardless of if it's free cash flow margin or operating margin, they'd still be above the rule of 40. So, uh, basically, RingCentral is they are the de facto leader of the mid market right now, and they are expanding upwards, as you can see. Up 53% versus their total revenue up 35% on enterprise, which is companies with more than 1,000 employees. I think that should actually be around half of its ARR right now, if I remember, is around 1,500 million. Uh, so its ARPU is stable, which means that it is gaining more revenue through getting more customers versus actually increasing the revenue they get per customer. 82% is also really solid gross margin. It's also improved a lot. One problem with RingCentral, like as any other growth company, they do dilute shares for stock-based compensation of 4%. And if you care about what analysts say, uh, they say there's 140% upside, but they up yeah, they're not reliable. And actually, I my thing is way lower than what analysts expect for the company, basically on average. If we change that, I want to see what we get. Uh, 22, 22, 21, 22, 18, 15, 12, oops, 8, sure, 5, yeah. Alright, we get 88. That should be around, actually would be closer to my base case for RingCentral. Uh, so I was talking about the free cash flow, and their guidance would be around 27 to 26%, which is what I did. Yeah, I'll change it to 25, but yeah. Uh, and yeah, that's it for today, and thank you for watching.